Good morning, everyone. We're just going to give it another 30 seconds. Participants are getting let in now, and then we'll kick it off. Good morning. Welcome to the September 7 Bridge webinar. I am Justin Ferraccio. I think there's a couple of new faces on the meeting today. Um, Been with the firm for about 5 years, and I'm one of the two owners. This is the founder and the owner here, Chuck Eberly.
Hey, good morning, everybody. Glad you're here.
Just a kind of a quick reminder of the purpose of this meeting is to for Chuck and I to give some perspective on what's going on in the economy, the stock market. Occasionally, we'll bring in speakers, insurance people, all kinds of different fun stuff, estate planning. So today, we're going to kick it off and go through the agenda here in a second. But this is not meant to be a replacement for your individual questions for your client meetings. This is just kind of a substitute. Instead of doing a newsletter, we thought this would be a little bit more engaging. If you're ever not able to come to this meeting, but you're interested in the content, just reach out to myself or our team. We'll send you a recording and you can watch it on loop because it's so fun. I'm going to share my screen and we'll kick it off. Okay, so agenda today, we're going to go through year-to-date market performance. And the kind of the bulk of the presentation is going to be talking about four key assumptions or four key expectations impacting markets through end of year. And then we'll pass it off for questions. So if you do have questions, you can enter them directly into the chat window on this webinar. They come to Chuck and I directly. No one else sees your questions. We'll do our best to get through all the questions today. If you have a question that pertains more to your personal situation, or we don't get to your question, we'll reach out to you after the call later today and we'll talk through those things. So year-to-date market performance, the Dow is up almost 7% this year now. S&P is about 10%. NASDAQ, which is more technology-focused stocks, is up 12.8%. Russell 2000, which is small and mid-cap, is up 7.3. Equal weight S&P, so you see two different S&P readings here. The S&P 500 traditional is weighted by market cap. So the biggest companies get more weighting in that S&P. So NVIDIA, for example, is such a large company that 7% of the traditional S&P reading is made up from just NVIDIA. So almost 30% of the S&P is weighted by 10 to 12 companies. So the equal weight basically takes the 502, 503 stocks in the S&P and says what happens if we weight them all exactly evenly, and that gets us closer to 7.5%. The bond market is now up 3.6% on the year. So, between August meeting and this meeting, the biggest movers were the Russell 2000 is up almost 3.5%. So the small mid-cap companies have had a good rebound in the last month. And then the bonds have come up about 1%, which is a pretty big move in the bond market. So as you can see with the S&P, the reason the S&P is up more than equal weight is because those tech companies have continued to run strong through this year. So four key expectations impacting market through end of year. AI-driven stocks continue to rally. The tariffs will not cause stagflation. We'll get 2 rate cuts in 2025 and numerous more in 2026, 2 to 3 more. Geopolitics will not cause a spike in oil prices. So these are the kind of four things we're going to go through in more detail, and then we'll open it up for questions. Expectation one, the AI-driven rally continues. So, as of today, we've already had 2 of these key companies report earnings. So we have NVIDIA, Broadcom, Taiwan Semiconductors, Google, Microsoft, Meta, Amazon, Apple, Palantir. So these are the key AI stocks right now. NVIDIA reported August 27th. They had great earnings and they had good guidance. And what we saw from the stock is it was pretty flat, right? Because expectations were pretty high for NVIDIA. Broadcom also reported last week. Broadcom's earnings were great and their forward-looking forecasts were also great. And that caused a 10% jump in that stock. I think that's important because, all these earnings are super important just kind of for us to speculate what's going to happen through the end of the year, right? There were some concerns that AI spending may cool off. And if AI spending cools off, that's going to cool down the economy substantially. And what we saw from Broadcom and NVIDIA were really great indicators that the AI spend has not slowed. Forecasts have continued to go up and look really great. So kind of the next big reportings are going to be Taiwan Semiconductors in October. So kind of end of October is a huge run. So we have Taiwan, Google, Microsoft, Meta, which is Facebook, and then Amazon and Apple. So that run right there will be super important for us to kind of get a grip on, what is going to happen through the rest of this year, through the rest of next year in terms of AI spending. So we talk about earnings, we talk about forecasting. Another really important thing is, CapEx, how much are these companies spending? And if you look at the spend right now in AI for 2025, it's right now projected to be about $360 billion. The AI spend for 2026 is projected to be $500 to $600 million.
Billion.
Billion, sorry. Thinking small today. And if you look at kind of the aggregate of now through the next 3 years, it's really hard to get a really good grip, but projections are anywhere from 1 trillion to $3.5 trillion, right? So I think that gives you a really good idea of the amount of money that's going towards CapEx from these companies and how much that will fuel the economy moving forward. And when we talk about AI and think about AI, it's not just these 7 or 8 companies. AI is everywhere now. It's in companies like Caterpillar, which is an industrial company, makes tractors, building AI centers. It's in, you think about electrical utility companies. These companies use massive amounts of power for AI and they need to get it from somewhere. So, what Chuck and I constantly are trying to balance in our investment team is what's the appropriate allocation to AI. We want to have enough to participate. We don't want to have too much where we can get hurt if this goes against us and doesn't go the way we expect it to go. So that's something we're kind of constantly working on and thinking through. And we compare this to, what happened in the late 90s with the dot-com boom, right? Everyone kind of thought, full steam ahead, all systems go. And most of those companies, or a lot of those companies, did not survive, right? So it's kind of the first mover advantage. You even look at NVIDIA now, it's so hard to think of a way that NVIDIA can fail. But people said the same thing about AOL, Intel. Intel took longer, but it did not live up to expectations. So that's kind of what we're trying to balance out. We want to have exposure to these companies. We want to participate in the upside, but we don't want to have too much exposure that we get hurt too badly if this doesn't pan out exactly the way we hope it does. Anything you want to add there?
Nope.
Great.
Nope. Okay, expectation number 2, tariffs and stagflation. So think back to April when, the tariffs were announced and, all the uncertainty there, is it going to bring back inflation? Is it going to kill the economy? Big decline very quickly and then a pretty quick recovery. But this is still, kind of a key element of, things continuing or, we have a good return this year, for that to continue, all 4 of these expectations, are very key to a continuation of a good stock market, a good economy. So right now, what we're seeing with tariffs and inflation, stagflation, the data points are not pointing towards, any trouble. Retail sales are strong. The labor market's weakening, but it's not a collapse. The last week we had the new jobs were lower than expected. It's a sign of weakening, but it's not a sign of a collapse. So key things for us to watch, you to watch, the manufacturing index survey, unemployment numbers. JOLTS is another survey that's done on employment, retail sales numbers, durable goods, Thursday, we have the consumer price index coming out, and then the core PCE is, I'd say, the key piece of data that the Fed looks at. It's basically looking at, looking ahead to what prices are going to be for consumers. So right now, there's no red light or, yellow light. I'd say the only amber would be labor. Labor's showing some sign of weakening. The rest of them are strong. And we got some charts to show, the one on the left is retail sales, or that's capital goods, isn't it? Retail sales on the right.
Capital goods on the left.
Yeah, so that's capital expenditures on the left. So that's what companies spend, when they, AI spend and other things that they capital improvements. So that's a sign of business. The retail sales is a sign of the consumer. So both of those are strong and trending the right way. Then we have unemployment, which, here again, it's not showing a collapse, but it's definitely showing weakness. We got the unemployment rate on the right going up a little bit, and basically new unemployment applications is pretty flat. So right there, that's something that we need to watch for sure. Rate cuts, another key component. If you think about these rate cuts, right now the Fed meets on the 17th. Everybody's expecting a 0.25% reduction in the Fed funds rate. There's some talk about it being a 0.5 point right now, but chances are it's going to be a 0.25 point. That's kind of priced in. Then another one in December, and then as we go look in 2026, we're kind of expecting from right now, say June of next year, fall of next year, that the Fed funds rate will be 1% less than what it is right now. So that's priced in. So kind of a danger to the market going higher would be that some economic piece of data shows up that would cause them not to cut rates. That would be a negative. I don't think the fact that we get this rate cut on the 17th is going to mean the market's going to take off. It'll probably be flat. It'll be one of those cases where you scratch your head, they cut rates and the market didn't do anything. But if they don't cut rates, I think we could see the opposite happen. Okay, now we talk about oil prices. If you think about oil, if oil prices are too high, that'll potentially slow the economy down. So kind of the Goldilocks oil price is between 60 to 80. Right now we're around 63. So we're in a good spot for oil. It's gone up a little bit today, but if oil prices are too high, it's going to be inflationary, which is not good. And also, higher oil prices will slow the economy. If oil prices are too low, it's a sign of global economic slowdown. So oil is a good thing to watch. If you think about geopolitical, news with the different wars and tariffs, has a big impact on oil, and that's really what we're watching with what's going on in Ukraine. Is if a ceasefire happens, it's going to make oil prices go down. Right now, Putin did another attack over the weekend, which now we got more talks about tariffs on India, China, to punish them for buying Russia oil, which, that's the big thing to watch with oil prices right now is, do these tariffs on these countries cause oil prices to go up? And that's a simple thing to look up, is looking at crude prices and seeing the impact as the news happens. But right now, oil prices are good. We'll have to wait and see what happens with the tariffs and what's going on in Ukraine.
Okay, so we kind of already went through this, but just upcoming data points to pay attention to. Like Chuck said, Thursday is CPI. The Fed meeting is September 16th and 17th. That's when we're hoping to see this rate cut come to fruition. And then we have all these big earnings coming, Taiwan Semiconductors, Google, everything we talked about before. And then lastly, we have one more Fed meeting in December. And again, expectation is right now that we'll see another rate cut in December. So a half a point by the end of the year, all subject to change, but those are kind of best estimates at the moment. So I'm going to stop sharing my screen. Okay, let me see. We have a couple questions that have come in. I'll try to summarize these. Okay, as retirees, prices are hurting us right now. Specifically, groceries are way up. Going out to dinner is much more expensive. Getting coffee is more expensive. Um, what is guidance on annual withdrawals from accounts when you're retired? 4 or 5% is the question. So, everyone's situation is slightly different. A back of the envelope rule of thumb, 4.5%. Which means you can, of your investable assets, so you have $1 million invested, you can pull 40 or $45,000 a year in after-tax money, and that account will remain sustainable in perpetuity. It has virtually zero risk of collapse or failure, and that means that you're pulling that 4.5% every year during good markets, during bad markets. That doesn't change. We want to keep that number kind of the same, right? So we're not changing your quality of life just because there's a bad market. So when we talk about, 4.5, 5% withdrawals from your investable assets, that comes kind of consistently, and that we're already mapping in bad markets into that price. Anything you want to touch on there?
I think one thing to think about is like when we're running retirement numbers for people, say somebody wants to retire when they're 55. You have a much more a longer period of time that you're trying to solve for. So you want to be, I'd say, more cautious or more conservative. If you're 55, you're retiring, you have 35 years, potentially that you're not live off this money, and 35 years of the impact of inflation. So when you're solving for that type of, long period of time, I think 4% is definitely, a number to key in on. As you get older, you have less time that you're solving for, less time for inflation to impact you. So you know, you can withdraw more because you have less time that you're solving for. But the other key part of that is your investments need to be in line for the job they have. So you can't withdraw 4% and have all your money in CDs. You'll just plain run out of money. Um, you know, we look at it to have a balanced, moderate risk. You still need the growth, you need the income, but you need to achieve that 8.5, 9% return during the withdrawal phase. That gives you the ability to pull out what you need, but have a growing pile of money that you can continue to draw that 4% from, or 4.5. What we find, people get kind of stuck in their withdrawal rate as a number and don't look at the percentage, and they don't give themselves a raise as much as they should. So I kind of, look at your number right now. If prices are impacting you, let's have a discussion about bumping up what you're pulling out in distribution. Because the question's right on point. We get these CPI numbers that come in at 3%, but everything we're paying for is going up 6%, 7%, 8%. So costs are definitely going up. I think the key is having an investment strategy that solves that problem, right?
Yeah, and that comes back to planning too. So again, everyone's situation is different. And so, with questions like this, it's important that we get into the detailed planning, we run simulations, we have those conversations, and if we haven't had them for a while, we have them again and rebaseline. So next question is, what about Bitcoin and how does that fit into a portfolio? So, you know, we think about Bitcoin as another asset class now, right? So you have equities, stocks, bonds, crypto, real estate, right? So Bitcoin specifically, we're looking at, what crypto do we think has the best chance to survive, best chance for growth? Here we unanimously think it's Bitcoin. We think it has the most legs. We think it has the most pedigree. It's been around the longest. Um, so when we're constructing portfolios, and again, I hate to keep saying it, it's nuanced. Everyone has different risk tolerance. Everyone's trying to accomplish different things. But on a general broad scale, 1.5 to 3% of your liquid net worth in Bitcoin, we feel is appropriate if you have the risk tolerance for it, right? That gives us a chance to, say we're at 2% and Bitcoin goes from $100,000 a coin to $1 million a coin in the next 5 years. We participate in that upside. It is meaningful improvement in your portfolio. But at the same time, if it goes from 100,000 a coin to 50,000 a coin and is 2% of your investable assets, it doesn't hurt your long-term retirement plans, right? So it's trying to find that balance, but we do think that it's appropriate and it makes sense to have some exposure to Bitcoin at this point, right? And many of our clients do, and we'd love to have that conversation with you to decide how it fits into your portfolio.
Good questions.
Yeah, great. Those are all the questions we have. We do try to keep this to 15 minutes. We never actually do it, but we're pretty close. So we really do appreciate you taking time out of your day to spend it with us, and hopefully you found this valuable. If any questions pop up after this meeting, just reach out to us and we'll have discussions. But thank you so much.
Thank you. Have a good day.
Bye.
Bye.